I was thinking about what I wanted to share with you today. There's a lot of things to share. So unfortunately, we only have an hour, not quite an hour. I'll probably be speaking for 40 or 45 minutes, and we'll take some questions. But I'll try to share with you some poignant stuff, some important things that I think are worth talking about these days. I'm going to share my slide presentation with you now, so you can all see my my presentation. I'll just bring it up here. And hopefully you will all be able to see that. There we go. And really, I think, so I'm just gonna get my technology working properly here. There we go. I just wanna make sure I've got the right slide presentation. I'm looking at it on the right screen here, so let me try that again. Okay. There we go. And we will start this. There we go. We got the technology working now. So I thought because we're in the COVID-19 era, it's been a weird year, 2020, and there's just a lot of different things to be thinking about right now. So I thought I'd give you a bit of a tax and estate planning update in a COVID-19 world. And I want to be very aware of the fact that, your community foundation, as you know, our community foundation where I live, have been pretty instrumental in helping the community through this time. The needs in the community are so incredibly massive, and I didn't appreciate that until I really joined the board of our foundation. But I've come to understand really the importance and the important role that the community foundation plays. So I was really glad to help out when they asked me to speak here today. And this is anyway, a tribute to the good work that they're doing. So anyway, before we jump into some tax and estate stuff, I want to share with you on a lighter note, a top 10 list. So this top 10 list is takes me back to the David Letterman days when he had his top 10 lists. And this is the top 10 list that speaks to signs that you're paying too much tax. Okay, so you know you're paying too much tax when, and we've got 10 things here. So you know you're paying too much tax when, number 10, T4 is relevant to you because it's your apartment number. Number 9, RRSP is what you did in response to that wedding invitation last month. Hope that doesn't describe too many people. You know you're paying too much tax when, number 8, you tried to deduct Starbucks as a workspace. We've all probably been there. Number 7, you've been offered a job with the CRA and you tell them you'll take it if they pay you under the table. You know you're paying too much tax. Number 6, you choose to use cloth diapers instead of disposable because HST won't apply. So nothing can convince me that we should have been using cloth diapers way back when. So I apologize to those who are big on saving the environment. You know you're paying too much tax when, number 5, you pretend that you're a wounded veteran, your spouse is a volunteer firefighter, and your 8-year-old is a member of the clergy. That's when you know you're paying too much tax. Number 4, you turn yourself in for tax evasion in order to be paid the 30% reward for whistleblowers. And by the way, that's not actually a reward. You can't actually get 30% to my knowledge from turning somebody in. So anyway, that is true in the US. You know you're paying too much tax when, number 3, you're expecting yet another Christmas card from CRA this year. Number 2, you've chosen to use the short form tax return, which has just 2 lines. Line number 1, income. Line number 2, send it in. If that's you, you're using the wrong form. Okay, and then a sign that you're paying too much tax. Number 1, identity theft is a problem, but the thief wanted nothing to do with your name or identity. So there you have it, top 10 list. And that concludes our presentation for today. So thank you. Okay, we won't stop there. We'll continue on. I've had a chance over the last several months just to talk to Canadians and understand how they're feeling about what's going on, both from a financial perspective and specifically from a tax perspective. And if there's one thing one word I could use to describe how a lot of people are feeling, not everybody, but a lot of people, it's, I'd say, discouraged. A lot of people are sort of feeling discouraged today. You know, COVID-19 has really created the biggest deficit in history of the country. at over $350 billion this year. Our national debt has reached over $1 trillion. That just didn't seem possible even a year or two ago. Our debt to GDP ratio will approach about 65%. Now, how does that compare to where we've been? Well, we've been down around 35%. So it's a pretty significant increase in our debt to GDP ratio. As an aside, by the way, our GDP ratio was at about 67% back in the mid 90s, and we managed to claw our way out of that. So we will claw our way out of this. But I think one thing is for sure, and that is this, that tax increases are going to happen no matter what the government is saying today. So the government may be choosing not to increase taxes, or they're saying they're not going to increase taxes. It's only a matter of time before they will, and they're probably going to have to. And so with that in mind, I'll share with you my thinking on that in a minute or two as to what I think that might look like. But before I jump to that, I just want to talk about Tax Freedom Day for a minute. Many of you have heard about Tax Freedom Day. It's that day in the year up until which we actually work for CRA. And only beyond that date, you actually get to keep anything for yourself. So if you actually had to pay all your taxes up front at the beginning of the year, you'd be working in 2019, you would have been working until June the 14th in Canada to pay your taxes. And only after June 14th, would you actually keep anything for yourself. And the average taxes paid by Canadians in 2019 was about 44.7%. So rounded up to 45%. Those are all kinds of taxes, by the way. It's income tax, it's property tax, it's gasoline tax, it's liquor tax. And I do know that some people will pay a little more liquor tax than others, but it's all kinds of taxes. And you can see how we compare in terms of countries. So there's a list of countries here that I'm going to share with you. It's 30 countries, or the worst 30 countries, if you will. Or maybe it's just the 30 countries that actually report this Tax Freedom Day statistic. But you can see on a list of actually 31 countries, we're at number 9, which puts us up near the top of the list. If you want to take a look at where the US falls, they're down number 26, where the 16th of April represents their Tax Freedom Day in 2019. And the average American pays about 29% of all of their income in one form of tax or another. So bit of a gap there. It's not great news, unfortunately. And things will not get better as we move forward here. So what to watch for? What do I think is going to happen over the next year or two? There are a few things that I think we should be watching for. The changes that could come down the pipe could be very broad, very broad. But I think one thing to look for is the capital gains inclusion rate. So as you might know, 1/2 of capital gains, or 50% of capital gains, are now subject to tax. The other half are tax-free. Capital gains and the taxation on gains was introduced back in 1972. Prior to 72, there was no tax on capital gains. And actually throughout the inclusion rate has always been 50%, with the exception of the 1990s. For 10 years, from 1990 till 2000, till February of 2000, the inclusion rate was actually 75%. So some of you may remember that. So we'd be foolish to think that we won't be going back to perhaps a 75% inclusion rate. I think it's politically palatable for the government to make this kind of a change, because the perception is that it's just wealthier Canadians that benefit from the capital gains inclusion rate. I also think that depending what happens in the US, if we see the capital gains rate in the US increase, which could very well happen, depending on the election that's coming up in a few days. If we see capital gains rates increase in the US, I think it's almost a foregone conclusion it will happen here as well. What else to watch for? A wealth tax. I'm not suggesting this is a guaranteed thing to happen, but in other parts of the world, particularly in Europe, there are about 10 to 12 other countries that do have what's called a wealth tax. That tax can be anywhere from 0.5% to 1.5% of the wealth or assets of an individual. Some countries, like France, only levy that tax on real estate. But you have to believe that our government has been eyeing the real estate of Canadians, which has just increased in value incredibly. More in certain parts of the country than others, but just about everywhere, values have gone up. And so a wealth tax, even if it was just on real estate, would be easy to implement. We already have a system in place where property taxes are levied municipally, it would not be a far stretch to see the federal government attach another tax to that, which, you know, is collected maybe by the municipality, gets remitted to the federal government, maybe by adding another 0.5% to your property taxes. That could easily happen. It's already happening in BC. BC has something called a school tax, which is really effectively a property tax for the province. It applies to properties over $2 million of value, and I believe it's about 40 basis points, about 0.4%. So this is definitely something that would be possible for the government to implement, and maybe something they're thinking or will be thinking. Principal residence taxation. I wrote an article in the Globe Mail about this not too long ago. I'm not convinced the government's going to fully tax our principal residences, but I will say this, that the principal residence exemption, which we've had for a long time, it's been abused. For sure, it's been abused. We've seen people who are flipping properties and should not be entitled to the exemption, but are claiming it anyway. The government's looking for that kind of activity. They've got a project on the go where they're trying to catch people and doing that kind of thing. But, you know, because of the value of Canadian residences, as we talked about, real estate's has gone up in value so much. It would not be surprising to see our government implement a system that looks like the US type of system. In the US, you can't have an infinite dollar number tax-free when you sell your principal residence. In fact, in the US, it's $250,000 of tax-free gains on your principal residence per person. So a married couple, for example, would have $500,000 of exemption on their principal residence. But beyond that, there's capital gains taxes to pay. That is definitely something that could happen in Canada. If it ever did happen, I certainly hope that the government would also look at interest deductibility for mortgage interest, because in the US, you can claim mortgage deductibility, interest deductibility. I wouldn't hold my breath on that, though. I don't think that would actually happen, because that would be giving up too much tax in the short term. Every year, Canadians would be claiming mortgage interest as a deduction, whereas the tax on the sale of your principal residence only happens once every several years, or maybe a long period of time. So I don't think they'll allow mortgage deductibility if they make a change to the principal residence rules. For those of you who can think back a little bit, you'll remember that the combined GST and provincial sales tax, now we have the HST, was at 15% at one time. It's 13% in Ontario today. I could see this going up to 15% again. That may be just another way to accumulate more tax revenue. And lastly, there are definitely going to be some specific measures that the government's going to introduce to change planning, potentially more likely for the affluent, or who they perceive as being the affluent individuals using these ideas. There are all kinds of tax ideas out there. And, you know, for example, the government's already said in the speech from the throne, already said they're going to be attacking or changing the rules around stock option deductions. We've known that that's been in the works for a while now. I wouldn't be surprised to see other things coming down the pipe as well. There are lots of ideas that successful Canadians are using to minimize tax, all legal. It's just the government's looking for revenue. So I could see some of this changing. I don't know that they'll change the taxation of family trusts at all. Who knows, maybe that's because our Prime Minister has a trust fund. But you know what, whatever the reason, let's hope they don't go crazy on this and change some of the more fundamental basic planning that Canadians are able to do. So anyway, that's the bad news. It's sorry to be the bearer of bad news. I don't know how you're feeling about all that now that I shared that with you. We could end the presentation right there, but I'm not going to do that because there is hope. Okay, and so now what I do is I want to turn our attention a little bit to talk about, we'll talk about home office expenses, because many Canadians are working from home right now. CRA has come out with some more recent pronouncements around home office expenses. I'll talk about that. I want to share with you a little bit about giving back, and a way to do that not only helps perhaps your favorite charity or the London Community Foundation, but can also help your family, and all at the expense of CRA. And CRA is actually okay with these ideas, with this particular idea, because it does help charity. And lastly, we'll talk a bit about donating securities, and just an idea or two there for you as well. So let's move into our conversation about home office. And first question I always get asked is who can actually claim home office expenses? Normally, employees have a difficult time claiming them. This year will be an exception, and maybe next year as well, we'll see. Self-employed individuals have always had an easier time claiming home office expenses, and that continues. And commissioned employees are sort of differentiated from other employees who are on base salary or whatever, just in terms of what they can deduct. So I'll talk about that in a minute. But there is a criteria you have to meet for claiming home office expenses. First of all, your home must be your principal place of work. So one of two tests has to be met. Either your home is your principal place of work, meaning that you spend 50% or more of your working time at home, or, this is an or test here, not and, but or, your home office must be used solely for work. And in addition to that, it's used on a regular and continuous basis for meeting customers or clients. Now, not many people are meeting customers or clients today, face-to-face anyway. And the crazy thing is, CRA has said at one point in the past that you actually had to meet face-to-face for this to qualify. For these expenses, I would expect that they'll make an exception to that for 2020, and they'll probably go back to saying, okay, if you have a Zoom call or a video conference call with a client or a customer, you're probably okay. I'd be shocked if they didn't do that, but they haven't made an announcement about that yet. I'm sure they will. So here's the problem. The problem is that, and most people, by the way, will meet that 50% test more quickly than they'll meet the test where you've got to meet with your clients in your home. But the question becomes, what does 50% mean during the pandemic? Does that mean that half of your time throughout the entire tax year 2020 has to be spent working from home? Does it mean that half of the time during some part of the year needs to be spent working from home? It's not really clear. Our tax law actually isn't clear on this because our tax law never anticipated a pandemic. So we do have some guidance though from CRA. This was we were in limbo for a little while. We just didn't know what to expect here. But CRA has provided some guidance. Just last month, they came out with some information. They came out with a simplified tax form potentially to be used for claiming home office expenses for this year. Because if the normal form is quite cumbersome to fill out. This one, and by the way, it's a form that your employer is supposed to fill out. And if you're an employee and your employer is supposed to sign it, but there is a simplified form that can be used. By the way, this form, it's been released. You can look at it, but it's not finalized yet. They're waiting for comments from the tax community and from Canadians on this form and on the whole approach to how to claim home office expenses. But assuming this form is going to be required, it's a shorter form than the normal T2200. And what they've also clarified in this form is that you can claim expenses if you were required to work from home at least half the time during one or more periods in 2020, as long as those periods are 4 weeks long. So follow me here on. You can claim expenses if you were required to work from home at least half the time during one or more periods of 4 continuous weeks. So that's going to include a lot of people. A lot of people will fall into that category. And by the way, another requirement is that you have to have an agreement with your employer that you are required to work from home. But CRA has said, and this has always been their policy, you don't have to have that in writing. It doesn't have to be written into your employment contract that you're required to work from home. If you have a mutual understanding, especially during COVID, that you're required to work from home, then that's good enough, as long as the employer signs the form to check the box and say, yes, you are required to work from home. By the way, just one last thing on that. A number of accountants and lawyers have reached out to CRA and have already said this is a really bad idea. People should not have to fill out any form whatsoever for home office expenses this year. A really good idea that I heard, and I think CRA should seriously consider it for employees, is that they should just add a box to your T4 slip. And rather than filling out a whole form, just get the employer to check a box on the T4 slip that says, yes, I work from home. And that's a lot less administrative work for companies and small businesses. Otherwise, it can be quite a burden. Okay, that's all I'm going to say on that. But let's talk just for a second about what can be deducted. So first of all, it's going to be a portion, not all, but a portion of your home-related costs. That portion is normally based on your square footage that you're using for your home office. So if 15 or 20% of your home is used as a home office, then 15 or 20% of quite a few expenses could be deductible. Be very careful if you get up to the threshold of about 50% or more of your home used as an office. That would be an extremely rare situation. And if you do actually use 50% or more of your home for work, and you do that over an extended period of time, you do run the risk of jeopardizing your principal residence exemption. Because the government, what's required under our tax law is that really that your home be ancillary to your use of it. Your home be primarily a home and only ancillary. The use of your home as for business purposes has to be ancillary to your use as a residence. In other words, it needs to be primarily a residence, not primarily a business office. So be careful about a very high percentage there. What kind of deductions can you claim? For employees, it's a more limited number of things. It's rent or not even mortgage interest, but a portion of rent, heat, hydro, repairs, maintenance, which can include landscaping, supplies, which includes everything from printer ink to paper to toner to cell phone airtime. Those kind of things can be deducted as supplies. If you're a commissioned employee, you can add to that list property taxes and insurance. Still can't add mortgage interest. But if you're self-employed, now you can add mortgage interest as part of your deductions that are available, a portion of your mortgage interest. You could even add, if you're self-employed, depreciation on your home called capital cost allowance, but I don't recommend that because claiming CCA could, again, jeopardize your ability to claim your principal residence exemption later, and we don't want to see that happen. So that's it for home office expenses. Next steps, just make sure that, at least for the time being, that your employer does plan on signing Form T-2200 if you're an employee. There is the shortened version of the form. CRA will make a final announcement probably before the new year about whether or not they're going to require a form at all, or whether they're just going to say, look, check a box on the T4 slip. But no matter what, one way or another, your employer is going to have to verify that, yes, in fact, they expected you to work from home for some part of the year. And you may want to talk to your employer about that now, just to make sure that they're thinking about this and that they're going to be willing to accommodate you here. Also, just start tracking your home costs during the weeks that you're working from home. Keep track of all those things I talked about. Have them handy when it comes time to file your return. Okay, second idea I want to talk about is called an insured donation of shares. Now, this idea, I'm not talking about donating publicly traded securities, whether it's stocks, bonds, mutual funds. I'll get to that in a minute. We will talk about that. Right now, I want to talk to those of you who have private companies. You could be a business owner. You might have a holding company. And if you have a holding company, this idea can work wonders for eliminating tax on your private company shares. This idea will create a structure that's going to eliminate tax on those private company shares when you're gone. It's going to provide a meaningful gift to charity. And at this point, I'm going to pause and just again, ask you to give serious thought to what you might be able to do this year for the London Community Foundation or for the other charities you're working with. I know that the foundation is so focused on supporting the community, which includes supporting other charities who are doing critical work in your community. But even more broadly, just beyond this year, as you do your estate planning, think generously. I encourage you to do that. It's not just tax savings here. I'm going to show you some incredible tax savings, and you're going to look at it, and they're quite attractive, these tax savings, but just because it's the right thing to do, to give back to the community and help. And I'm sure if you're on this call, you probably are thinking that way anyway. But I would encourage you to, and speak to the folks at the London Community Foundation about the needs in the community, because no one has their hand on the pulse of the community like the foundation does. So this idea will allow you to eliminate tax on your private company shares, leave a meaningful gift to charity, and actually leave a lot more to your heirs at the same time. And we want to keep in mind when we're doing this, we're trying to keep things as simple as we can, and trying to keep the cost of implementation low. And let me get into just how this idea works. So hopefully you can see this. It's kind of a small picture. I apologize for that. But here we have a shareholder. This individual has a holding company. And let's just say the value of the company is $2 million, just for lack of another dollar number, just to make it easy. So $2 million. In this particular case, this shareholder has completed what we call an estate freeze. you can see that here because this individual owns shares in the holding company, and they're frozen shares, which means they're not growing in value. That $2 million number is locked down. Any growth over and above $2 million is actually going to the common shares, which are owned, in this example, owned by a family trust. So it's a fairly straightforward, simple, common structure. So the situation is, upon this individual passing away, and let's supposing that the shareholder ends up leaving the shares that he owns it's a him in this example, as you can see in the picture, but could be a woman as well. But the shareholder is going to leave their shares to their spouse, which is a common approach to defer the tax when they die. But there will be some tax to pay eventually when the second spouse dies. So upon the passing of that second spouse, what happens? Well, those shares are deemed to be sold. Like everything else you own when you die, it's deemed to be sold at fair market value, in this case, $2 million, and there's going to be some tax owing. Now, the tax bill, based on the year 2020, tax rates this year, would be $535,000 in this example, on a $2 million value of a company. Company that's worth $10 million, again, take that same percentage, it's about 26.7%, so it's a little over a quarter of the gain, and that's your tax liability. Now, we could take steps to eliminate this tax bill and help the family and charity at the same time. So how does it work? So first of all, this holding company is going to purchase a life insurance policy, and the holding company will be both the owner and the beneficiary of the policy. Now, for those of you who already have insurance in your life, or maybe have insurance even inside your holding companies, that's even better. You're pretty much set to go. For many people will buy life insurance in some cases to cover taxes when they die. You know, the taxes we've just talked about. And you could use the insurance for that reason. You could actually take the insurance when you die, and it can be paid out of the company tax-free and paid to CRA to cover the tax bill. Personally, I would much rather see you eliminate the tax on those holding company shares and keep the life insurance and use it for a different purpose, for giving back to charity and helping your family. So that's what this idea is going to do. So in this case, the amount of life insurance that Mr. Shareholder is going to buy in this example is going to equal 1/2 of the value of the holding company. Now, when you do the actual math on this, it might be 40%, but 40 or 50% of the value of the holding company, as a general guideline, will typically allow you to eliminate all of the tax on all of the shares of that holding company. So this policy could be a joint last to die policy. It's cheaper that way. By doing that, you know, the insurance doesn't pay out until the second spouse is gone, but because of that, it is a cheaper kind of insurance to buy. In our example, the cost of the insurance for spouses who are age 55 years old, the annual level cost of that insurance would be $12,000 a year for life. Now, approximate, it depends on your health and your age exactly, but you know, just a ballpark. In our example, we're using that number. Now, the alternative is that you could pay for this insurance over, say, a 10-year period of time, and after 10 years, it's all done, it's all paid up, no more premium payments to make. That would probably cost you about $30,000 a year. So the total cost of this insurance over the lifetime of this individual, or over to at least up until age 85, is about $300,000. Now, what happens when the surviving spouse passes away? So this person has now passed away. The shares are now sitting in the estate of the individual, the $2 million worth of frozen shares. Again, as we talked about, there's going to be a tax liability of about $535,000 owing in this example. But what the will of that survivor is going to say this, that 1/2 of those private company shares, of the holding company shares, are going to be donated to a registered charity. Could be your community foundation. And when that happens, and by the way, this will also work with other charities too, quite possibly, but it's important that you speak to the charity because not all charities are equipped to receive private company shares as a donation. The good thing in this example is that the shares that the charity receives will be quickly converted to cash. So there should be no issue in terms of how much of a value to issue a donation receipt for. But anyway, in this example, we've got 50% of those shares donated to the charity. That's $1 million worth of shares. Now, what does $1 million do for you as a donation in the year of death? Well, there's going to be a donation tax credit on the final tax return. And that's going to provide tax savings of just over $500,000. So it offsets almost all of the tax that would otherwise be owing on the shares. Now, the reason that the tax relief is $500,000 and the tax bill that otherwise would have been owing was $535,000, the reason there's a difference there is because in Ontario, and Ontario is one of few provinces like this, the donation relief, the relief you get from a donation of $1 isn't quite as high as the tax on that dollar when you pay tax on it. So you don't quite get the full donation relief, but you get most of it, most of the relief there. So we've eliminated most of the tax, all but about $30,000 here. Now, what else happens? Well, when you pass away, obviously the life insurance gets paid out into the holding company. And that death benefit, it's going to be $1 million because that's the face value of the policy. But on top of that, there might be a cash surrender value there as well. So an accumulated amount inside the policy, which would also get paid out tax-free at the time of death. So the amount that's received by the holding company might actually be even a bit more than $1 million. And in my math here, I've assumed it'll be 1.2 million, a little bit over $1 million. The insurance is received tax-free by the holding company. Something else that it does is that life insurance bumps up something in the company called the capital dividend account. And it bumps it up by that 1.2 million or whatever the number is going to be based on your policy. So the capital dividend account is a very important thing because, as many of you may know, you're allowed, or the heirs or the shareholders are allowed to pull money out of that company tax-free to the extent there's a capital dividend account balance in the company. So it's like creating a tax-free pipeline to the heirs, to your heirs. Now, the holding company is then going to take that cash that it receives from that insurance policy, by the way, and it's going to buy back, redeem those shares that are owned by the charity. Because as much as the charity appreciates getting your private company shares, the foundation or the charity really can't use your private company shares that much. All right, the foundation would much rather have cash. And this does that. This allows the cash to go out to the foundation of the charity. The charity is not going to pay any tax on that redemption of shares, unlike an individual, okay? Because it's a charity, of course. So there's no tax to pay. The charity ends up with the $1 million of cash to use for its charitable purposes. Now, we're not quite done yet. There are two other tax benefits here to talk about. The first tax benefit, which we just talked about, was the donation of the shares eliminates the tax on all the shares. That's the first benefit. But the estate also creates, we can now create a tax-free pipeline out of the holding company to the heirs, to your estate or your kids or your beneficiaries, your heirs. How do we do that? Well, we do that by that estate is going to redeem $1 million worth of shares, or whatever balance is in that capital dividend account. Your heirs are going to redeem that value of shares, and in exchange will receive a promissory note. Now, the interesting thing is that there will be no tax to pay on that redemption of shares. Normally, that's taxed as a dividend. It's called a deemed dividend, but in this case, there's no tax to pay because it comes out as a capital dividend out of the capital dividend account. So what we've done is we've effectively created a tax-free pipeline out to your heirs now. In this example, that tax-free pipeline is going to save your heirs $572,000 in tax. Pretty meaningful number. So one more thing that happens, one more tax benefit. When this redemption takes place, so your heirs redeem $1 million worth of shares in this example, and create that tax-free pipeline, it does something else. It creates a capital loss in that process. It creates a capital loss in your estate, which can be carried back and claimed on your final tax return. And that's going to save another $160,000 in tax in this example. So let's summarize it all now. There is the do nothing scenario where you've got a private company, it's a holding company maybe, and you do nothing. In that example, you pass away. If the company's worth $2 million in our example, then CRA is going to walk away with $535,000, and your heirs effectively get the rest. Charity gets nothing. Then there's scenario two. You might say to me, well, Tim, I really like this idea, but the only part I don't like is the insurance part. So what happens if I just exclude the insurance? Because I don't believe in insurance. If that's the case, you could still donate about half of your private company shares, and that will eliminate most of the tax owing to CRA. Maybe there'll be a little bit of tax owing because of that wonky tax rate in Ontario. And the charity will receive $1 million of value, half the value of your company, because you're giving them half the shares. Your heirs would get the difference, $968,000. The only problem with this picture is that the money that's received by the foundation or the charity is not cash, it's private company shares. So not overly helpful. Now, let's look at scenario 3, which is the scenario I was just talking about, where we give half the shares to charity, but we also buy insurance as part of this planning. In this example, the charity gets the $1 million of cash, as we've talked about. Your heirs get $2.6 million of value. Where does that come from? Well, there's a lot of tax savings here that come from this. And there's a little bit of life insurance on top of that that is left over. The extra $200,000 or so over and above that $1 million that went to the charity, there's a little bit of life insurance left over in this example that goes to the family, on top of all the tax savings I just talked about. All right. And so when you add it all up, the family ends up with about $2.6 million of extra cash in their hands. The charity ends up with $1 million. CRA pays the tax, pays the bill themselves. So this all comes at the expense of CRA. And you may ask, well, what does CRA think about this idea then? In fact, all of the tax areas of our tax law that come into play here with this strategy are well-established areas of the tax law. And because it involves making a significant gift to charity, CRA has never had a problem with this. I've never seen them have a problem with this. It's actually not a very, in my view, not a risky strategy. Now, one last slide I'll show you on this, and that is simply this, that the net benefits of the strategy, who gets the benefits. So at the end of the day, we've created an extra $2.1 million of value here. That's over and above what it cost you to buy the insurance. So that's in terms of taxes saved, which is about 1.2 million of taxes saved, cash to the foundation of $1 million, plus a little bit of extra insurance money that goes to the family of a couple $100,000. And of course, we have to subtract from that the cost of the insurance. But the net there is about 2.1 million. Well, who gets that? You can see on the right-hand side here, the family ends up getting 1.1 million of that, and the foundation gets 1 million of that. So that's how much better off each of these entities, your family and the foundation, are because of the strategy. Another way to think about it, for every dollar of insurance cost that you pay, there's about $8 of overall benefits, with about $4.79 of that going to the family and about $3.33 of that going to the foundation. So there you have it. Last idea before I finish off. We're going to talk about donating securities. You may be familiar with the concept of donating stocks, bonds, mutual funds to charity. So ask yourself the question, today, do you own any stocks, bonds, or mutual funds, or other publicly traded securities that have appreciated in value? Because if you do have something like that, then there's an ability to eliminate all of the capital gains taxes on those investments while helping charity at the same time. So I'm going to walk through an example of how that can work. But before I get into the example, I'll just remind you how, when the rules changed, it was back in 2006, can't believe it's been that long ago now, where the government eliminated the capital gains on the donation of publicly traded securities. So in other words, that capital gains inclusion rate, which is currently currently 50%, might go to 75%, becomes zero when you donate securities to charity. So I've had people come up to me and say, Tim, there's a particular stock or security I want to sell, and but I want to keep some of the money for myself, and I also want to give some to charity. Can I do that? And how much tax benefit is there to that? Well, make no mistake, you could give all of a particular stock or all of a particular mutual fund to a charity if you wanted to, but you could also give a portion of it and still eliminate all the tax owing on those securities. So let me show you how a partial donation can still eliminate the tax. Let's walk through an example. Take an individual, let's call her Sarah, and she owns shares in a company, call it publicly traded company, say XYZ Corp, which trades on the one of the exchanges, and is worth $100,000, but Sarah only paid $50,000 for the XYZ shares. Now, Sarah wants to sell her XYZ shares. Maybe she's convinced that the company's had a good run and the stock's not likely to go up in value much more longer, or maybe it's just time to sell, or maybe she just wants to give to charity. She wants to donate some of the value to charity in this example. Now, if she were to sell all the shares, sell the $100,000 worth of shares, that's going to trigger a tax liability of $13,383, okay, if she's in the highest tax bracket in Ontario. So the cash that she's left with after selling these shares, okay, there's no donation yet, but after selling these shares, she would be left with $86,000, a little over $86,000. So here's an idea. Maybe Sarah should think about donating $20,000 worth of shares, worth of those XYZ shares, to charity, to the London Community Foundation, and then sell the balance that are worth $80,000 and keep that money if she wants. So what does this do? Well, there would be $10,000 in taxes owing on that $80,000 worth of shares that she keeps and sells. She does not donate, but she sells and keeps for herself. There's no tax to pay on the shares that are donated to the charity. So the $20,000 worth of shares that were donated, there's no tax to pay on those capital gains. But in addition to that, there's a donation tax credit that Sarah gets for the $20,000 donation. And that donation tax credit is going to be worth over $10,000. So in other words, that donation almost fully eliminates all the tax owing on the rest of the shares. So the $80,000, how much in cash does Sarah keep in this case? Well, the $80,000 that she wanted to keep for herself, there's $626 in taxes owing on that, not much. So $79,000 is what she keeps. So let's summarize this now. So her cash in hand after the donation is $79,374. How much did she give up because she made the donation? Well, she made this donation, but if she hadn't made the donation, she would have pocketed $86,000. So she's only out of pocket $7,200. So yes, she's out of pocket a little bit, but she's only out of pocket $7,200 while the charity or the foundation receives $20,000. That's a fantastic, what we call a charitable arbitrage opportunity. So something to consider. Now, the question becomes, how do you figure out the amount you should give to charity? So in our example, Sarah had $100,000 worth of stocks in XYZ Corporation. She donated $20,000 and kept $80,000. Well, how did we arrive at that ratio? How do we figure that out? Well, it's by way of a really ugly formula, okay? I'm proud to say I dug out my grade 10 algebra and figured out the formula. Did that a few years ago. I'm not sure I could do that today. But anyway, this is the formula. It's the amount that you should donate equals the fair market value, the $100,000, multiplied by the gain on the portfolio, on the investment. Divide that by 3 times the fair market value minus your adjusted cost base. Okay, let me put some numbers to that. In Sarah's example, here's the math, and it comes down to $20,000. So out of the $100,000, she's going to give $20,000, and that basically eliminates all the tax owing on the rest of the shares. You can do the math yourself, depending on the amount, the gain on the investments that you've got, and how much you want to donate. And or if you can't do that, ask a financial advisor or your accountant to do that for you. And you can get the math done pretty easily. So where have we been? Well, we started off by looking at the top 10 list, the top 10 signs that you are paying too much tax to CRA. I shared some bad news with you, unfortunately, about what's happening. Obviously, with COVID, I think it's no surprise that taxes are likely to increase. Tax Freedom Day in Canada is moving in the wrong direction, unfortunately. But I did share that, of course, there is some good news. And we talked about 3 specific ideas. We talked about home office expenses. And maybe in 2020, you have an opportunity to save some tax that way. Don't get your hopes up that it's going to make you wealthy claiming these home office expenses. Okay, but a few $100s or maybe a couple $1,000s, depending on your home office expenses, is better than nothing. And we talked a bit about the insured donation of shares concept and donating some private company shares to the foundation or a charity that's set up to accept those kind of shares. If you want to use a private foundation, it's a little bit more complicated and you have to jump through some more hoops. It's much simpler using a public foundation like the community foundation, but we talked about that idea and how that can really multiply what is in your family's hands and what is in the foundation. And really CRA is funding all of that. And lastly, we talked about donating securities and how to figure out what portion of an investment or portfolio you might want to donate to eliminate all the capital gains. So that's where we've been. I'm glad now at this point to take any questions that you have. I think we're pretty much on time, which is good. I think you're welcome to ask any questions that you might have by way of the Q&A button at the bottom of the page, and certainly I'd be glad to answer any questions you might have.
Okay, everyone. I'm Diane Silva, Director of Philanthropy here at London Community Foundation. I'm going to be assisting with the Q&A. So far, I see one come up. And Tim, the question is, in your industry, is it still just about all about tax avoidance at any cost? You know, we do know that in Canada there are benefits, but what's your sense in your industry?
So it's a good comment. I know people. There is no shortage of people who believe that we need to be paying our tax to the government. I'm one of those individuals. I'm fully aware and believe we all have to pay our fair share. We have a fantastic healthcare system. There's a certain amount that's required of us to pay, and whatever we're required to pay, we should be paying. Having said that, I don't think it's wise to pay more than the government is asking us to pay. And what I mean by that is that we are allowed to structure our affairs to pay less tax legally, and you only do this legally by using ideas that are available. And the government is okay with that. There still will be those who have the view that we should be paying more than our fair share, or more than, you know, maybe putting some of these ideas we shouldn't be using. I personally think that I would rather see the money go to charity than to the government. I know the governments support charity, but the reality is the governments don't support charity like they used to the same extent. So I would rather see that money in the pockets of Canadians who can in turn choose to give it all away if they want. And that would be fabulous. But so I think it's always a decision. You know, you've got a certain number of dollars. Where are those dollars going to go? Is it to the government? Is it to charity? Is it for yourself? You've got to make those decisions. And those are important decisions to make. And it's a decision everyone has to sort of think through for themselves.
Okay. And so we have another question. This one is from Vic Jindal. His question is, what are some of the issues and challenges that you might be seeing with some of your wealthy clients?
So I think, you know, the issues and challenges we're seeing, I think it depends on how much money you're talking about. You know, when a family has significant wealth, there are all kinds. People think, well, what a great problem that would be. Those kind of scenarios do come with challenges, additional challenges, because when there's enough wealth that it could go on to the next generation and maybe the generation after that. Now you're getting into governance. How do families share the wealth? How does this get divided up? How do you make sure people don't fight over it? It gets to be pretty a really important question. I think a lot of Canadians, regardless of level of wealth, including our clients, they do see the tax environment that we're in. They see that taxes are going up. They do see that the government is looking to target wealthier Canadians. And so wealthier Canadians are concerned about that. The clients I have would say, they'd be the first ones to say, look, we're wealthier Canadians. We have higher levels of income. We're okay to pay a higher percentage of our income in tax. They're okay with that kind of a tax system. The question becomes, how much is enough? Because when the marginal tax rate gets up to mid 50s or even high 50s, which it has been at in the past, you might recall we were at 57%, 58% back in the 90s. Then people say that's usurious and that's just not right. So people are concerned about where we're heading in terms of taxes, and I think that and making sure their families are looked after beyond their lifetimes to manage what's left behind in a prudent way.
Okay. Another question, they're coming in. So do you think the majority of accountants are aware of these strategies, or does it have to come from other professional advisors, in your opinion?
It really just depends on who you work with. There are ideas out there. I always say that no one has a monopoly on good ideas. There are a lot of ideas out there. We have the good fortune of seeing a lot of them, because if you look at our clients and many of them are wealthy, so they have who they're dealing with in terms of their accountants, their lawyers right across the country. In fact, we see a lot of the best ideas coming. And so we have a great inventory or reservoir of ideas. That's not to say that a lot of accountants have a lot of really good ideas. There's some really creative accountants out there. So I think if you're concerned about the taxes you're paying or what's coming down the pipe in terms of tax changes, reach out to your accountant, have a chat, have a conversation, or your financial advisor, and see what they've heard of, what they've thought of. I'm a big believer in sharing ideas. So we don't create ideas that are exclusive to, our group. I'm sharing with you some ideas today. Hopefully people can take those ideas and share them with each other, and these ideas get around.
Perfect. Is there a hang on, I'm starting to read one. Do you see USA citizens living in Canada permanently renouncing their citizenship for estate planning purposes? And is this getting harder to do from an IRS perspective?
Yeah, this idea has been around a long time. If you're a U.S. citizen and you renounce your citizenship, you can avoid estate taxes when you pass away. That's the reason people typically do it. The problem is we don't normally recommend people do this. If they're going to do it, they shouldn't do it till they're probably 65, 70 years age plus, because it may restrict your ability to move back to the U.S. Or do other things. So we don't normally like that kind of planning. There's other ways to avoid U.S. estate tax other than renouncing citizenship. So I don't see a stampede of people wanting to do this. It does happen every year. There are people, none of our clients have done it because we prefer to do other kinds of planning. But there are people who are doing it, and it is becoming harder to do. The IRS has now recognized it's an issue, and they've made the rules much tighter, much harder. And in fact, you can't get off the tax hook, so to speak, for a decade, for a 10-year period of time after you initiate that renouncing of citizenship.
Wow, okay. Is there a formula to determine the amount of insurance a holdco should have with or without an estate freeze?
Really briefly, you always have to ask the question, why am I buying the life insurance? I think you have to be really clear on your purpose for buying life insurance. I'm not saying I don't like life insurance. I actually love it as a tool. It's a very powerful tax tool, but you really have to know why you're buying it. And if you know why you're buying it, that will dictate how much you should be buying. So in the example of the holding company I gave, the right amount of insurance is probably 40 to 50% of the value of the holding company if you want to fully eliminate all the tax. I've had some clients say, I like this idea, but I want to buy 25% of the value of the holding company and eliminate part of the tax. So it depends on cash flow, what can you afford, and it depends on why you're buying it. So there's no one blanket answer there, but it's a good question.
Okay, and two more. These will be the last two. So the writer writes, Tim, great question. With life insurance option, should we not also consider the time value of money? Tomorrow's monies are worth far less than today's.
Absolutely, absolutely. So that's very true. So when you're paying your life insurance premiums, for example, that's money out of your pocket today and every year for the next number of years. You could do a calculation to figure out what's the present value of that stream of cash outflows, put a dollar on it today. And then likewise, you have to look at, when the benefits get paid out to you, what is the present value of that? We've done that math before, and at least for the strategy we've talked about here today, it's still really, really compelling. It's the benefits far outweigh the costs, even with the time value of money. But it's a good point. You have to factor that in.
Okay, and last question. How often do you suggest people revisit their will planning and POA and executor decisions?
Good question. We look at our clients' wills once a year. I think it's a good idea to take a look at your wills every year, even if you just read it over yourself to see, am I happy with it still? If you want a more technical review, you want somebody to look at it and say, well, the tax laws might have changed. Is my will still valid? I think you should be doing that every 3 years. And more often if you really think that something's changed in the tax law or state law that might actually affect your will.
Okay, great. All right, well, I'm just being mindful of time. I'll want to do a quick wrap up. So before I thank everyone, I just wanted to share a few things about LCF. Building on today's theme around proper planning, I do believe the fact that the foundation, through our volunteers and our board and due diligence, we've done a decent job, a great job on our planning, and especially it's demonstrated this, especially during this time of the pandemic. As the lockdowns were happening and panic was setting in, our foundation was still able to commit to our regular granting program, and in addition to that, pull income from our assets to seed the COVID-19 response fund. And I want to remind everyone, for those of you that haven't been thinking about this, but the community foundation model is really there for our community to provide a sustainable source of funding for our community in good times and bad through endowed family funds. Our platform allows families and individuals to establish very customized, flexible funds that suit your needs. We also offer succession planning, multi-generational funds, ensuring that your legacy lasts forever. And you can also think about LCF through your funds, giving through your will. As many of you know, LCF deeply knows our community. We know our needs. We're very plugged into the charitable sector, and we try to facilitate our donors' giving and ensuring that they're making the most strategic decisions and informed decisions with their granting. And we always try to apply a coordinated approach with our granting as well. So working closely with the United Way and other funders in the community, ensuring that we're being very strategic. Just some quick highlights for those of you who don't know LCF. We've been in the community for over 65 years. As of today, we have over 100 million in assets, and we have to thank our donors for that and the donors before us. So with our donor funds combined, we are currently granting over 4 million into the community, and that's just the power of investment year after year. In addition to that, we've carved out over 20 million of our unrestricted assets to do good in the community. So what we're doing is repurposing that capital for investments in areas of affordable housing and social entrepreneurs. So to date, I'm so proud to announce that our foundation has invested in over 400 affordable housing units, and our commitment is to invest in 300 units per year over the next 10 years. We can't do this work without our donors, and we thank them for their leadership and for choosing this model of philanthropy. So just like we're hearing Tim's presentation and how important proper planning is, and speaking with your professional advisors and connecting with them and revisiting those plans to ensure your wealth is secure for the future, we're always applying those values and those lenses also to our endowment, ensuring that we're here for the long haul for our community in London and Middlesex. We're always here to help, so definitely do reach out. On that note, I want to thank you sincerely, Tim, for your time and for sharing your expertise with all of us. You are truly a friend to LCF and to the Community Foundation movement, so it's a big honor that we even have you here today. I'm sure you're very busy. So thank you for your time, and in appreciation of your talk today, we're making a donation to your favorite charity as well, okay?
Well, so, thank you very much for that. I really appreciate it, and I love helping, and I want to thank everyone for participating today.
Thank you very much. And we are recording this session, so if anybody would like a copy, please reach out, and wishing everyone the best. And I see Martha's just logged in. Okay.
I'm just clapping. Thank you, Tim, so much. That was great. Awesome.
Martha.
Okay. Well, bye for now, everyone, and stay safe and healthy, okay? Thank you.